Have you ever looked at a losing stock in your portfolio and felt like you were just flushing money down the drain? When you're in retirement, or even just a few years away from it, seeing red on your screen isn't just a bummer, it feels like a personal attack on your security. You worked too hard for this money to watch it evaporate, didn't you? But what if I told you that those losses, as painful as they look, might actually be one of the most powerful tools you have to keep more money in your pocket and less in the hands of the IRS? It's called tax loss harvesting. I know, it sounds like technical jargon that only money people use to sound smart, but listen to me, if you are retired, you need to understand this. This isn't about playing the market. This is about being a warrior for your own wealth. Here is the problem. When you sell an investment for more than you paid for it, the government wants their cut. That's a capital gains tax. And in retirement, when you're living off your nest egg, those taxes can eat into your monthly budget faster than you can blink. But tax loss harvesting is the strategy of selling an investment that is currently down, at a loss, specifically so you can use that loss to offset the gains you've made elsewhere. Think of it like a balancing scale. On one side, you have your wins, the stocks or funds that went up. On the other side, you have your losses. By harvesting those losses, you pull them over to the other side of the scale to cancel out the wins. If you have $10,000 in gains but you harvest $10,000 in losses, your taxable gain becomes zero. Zero! That is money that stays with you. Now, I know what you're thinking because I can hear the fear in your voice. Susie, if I sell my stock when it's down, aren't I just locking in that loss? What if it goes back up tomorrow? That is a valid fear. But here is how a smart, savvy retiree handles it. You don't just sell and sit on the cash. You sell the loser, and you immediately buy something similar, but not identical, to stay invested in the market. This way, if the market rebounds, you're still in the game, but you've already captured that loss on paper to lower your tax bill. But wait! There is a major trap you have to avoid. It's called the wash sale rule. The IRS is onto us. They say you cannot sell a stock for a loss and then buy that same stock, or something substantially identical, within 30 days before or after the sale. If you do, they'll disallow your loss, and all that work was for nothing. So, if you sell an S&P 500 index fund from one company, you might buy a total stock market fund or a similar index fund from a different provider that tracks a slightly different index. You stay invested, but you follow the rules. Why is this so crucial for you right now? Because for many of you, your income has changed. You might be in a lower tax bracket now than when you were working, or maybe you're worried about those required minimum distributions, RMDs, pushing you into a higher bracket later. Tax loss harvesting isn't just about this year, it's about your future. If your losses are greater than your gains, you can use up to $3,000 of those extra losses to offset your ordinary income, like your pension or your Social Security. And if you have even more than $3,000 in losses, you don't lose them. You carry them forward into next year, and the year after that, until they're all used up. This is how you protect yourself. This is how you take a bad situation, a market dip, and turn it into a win for your bottom line. So, what is your actionable takeaway today? I want you to go look at your taxable brokerage accounts. Do not look at your 401k or your IRA for this. Tax loss harvesting only works in taxable accounts. Look for the red. Look for the positions that are down. If you have realized gains from earlier this year, or if you're planning to sell some winners to fund your lifestyle, talk to your tax professional or look at your software about harvesting those losses before December 31st. Don't be afraid of the red numbers. Use them. Be the master of your money, not a servant to the tax code. You've spent a lifetime earning this money, now spend 5 minutes making sure you keep as much of it as possible. Because when it comes to your retirement, every dollar you save in taxes is another dollar you get to spend on the life you've earned. With that said, thanks for watching and until next time.